You click this video because you are tired of watching your hand-picked portfolio swing wildly while the broader market marches higher. You want outsized returns, but the stress of playing earnings roulette drains your time and your capital. The era of guessing the next tech darling is over. Over the next few minutes, we dismantle the myth of the genius stock picker using brutal objective data. We examine exact statistics from the latest global market scorecards to reveal why active trading destroys wealth. We then explore specific, globally accessible frameworks to capture massive growth without staring at red and green candles on a screen. You will discover why the mathematics of the market are rigged against individual selection, how broad market capture optimizes your mobile lifestyle, and the immense structural advantage of self-cleansing portfolios. Whether you trade from a high-rise in Singapore or a beachfront in Mexico, this strategy secures your future. Let us dive into the mechanics of true wealth generation. You think your favorite technology company is a safe bet, but the underlying math tells a different story. When we analyze decades of market history, a terrifying reality emerges. The vast majority of individual stocks fail to outpace risk-free assets like standard cash over their lifetimes. The entire upward momentum of the global stock market relies on a tiny fraction of superstar companies. If your portfolio misses those specific winners, your wealth stagnates. The failure rate among those who try to time these individual moves is staggering. Recent market data shows that between 70% and 95% of day traders lose money, with only around 1% achieving consistent profits over the long term. Think about the concept of loss aversion. When an individual stock drops in value, human psychology compels you to hold on to it, hoping it recovers. When a stock rises, you feel an overwhelming urge to sell and lock in the profit. This behavior guarantees small wins and catastrophic losses. Imagine you are a digital nomad sitting in a vibrant cafe in Lisbon. You allocate $10,000 to a specific software stock. You spend hours reading corporate balance sheets and listening to quarterly earnings calls instead of enjoying your geographical freedom. A single missed earnings report drops the stock 20% in 1 hour. You panic and sell. Meanwhile, the broader market went up. You took massive risk for zero reward. The stock market is an engine for human progress, but picking individual stocks turns it into a slot machine. By concentrating your capital into a few select companies, you concentrate your risk. Every hour you spend analyzing a single corporate balance sheet is an hour stolen from your life. The modern investor values time above all else. Individual stock picking is a relentless time thief. If you cannot pick the winning stocks, surely the Wall Street professionals with billionaire backing can. The data proves otherwise. Investors assume that paying premium fees to active fund managers guarantees market-beating returns. The current 2026 market environment crushes this assumption entirely. We can look at the absolute gold standard of performance tracking, the S&P Indices versus Active Scorecard, better known as the SPIVA report. This scorecard measures actively managed funds against their passive benchmarks worldwide. The late 2025 data reveals that over a 15-year horizon, close to 90% of active large-cap fund managers underperformed their standard benchmark. Picture moving your tax residency to the Cayman Islands. You want to protect your newfound wealth. You hire a prestigious financial firm with marble floors and Ivy League analysts charging you a 2% management fee. They have supercomputers, complex algorithms, and insider networks. Yet the empirical data proves that 9 times out of 10, a passive portfolio tracking a simple index beats their returns. You are paying them a premium to lose your money. The professionals cannot beat the market because the market is a highly efficient pricing machine. active managers face immense institutional constraints. They suffer from cash drag when clients withdraw money, and they carry the heavy burden of their own massive fees. If the people who do this for a living fail over a decade, your chances of beating the market on your smartphone are non-existent. You must stop trying to outsmart a system that is designed to capture your capital through high fees and endless friction. So, what do you buy when you abandon individual tickers? You buy the entire economic machine. The solution is passive index investing. An index fund, or exchange-traded fund, tracks a broad basket of hundreds or thousands of companies. It operates as a ruthless, self-cleansing mechanism based on capitalization weighting. Capitalization weighting means the biggest and most successful companies automatically take up the largest percentage of the fund. When a company underperforms and loses value, its market capitalization shrinks and it takes up less space in your index. When a company thrives, it grows and commands a larger share of your wealth. You never have to predict which visionary entrepreneur will invent the next breakthrough technology. You own them all. Imagine making $100,000 in Dubai. You have zero income tax. Instead of deploying that capital into 3 isolated companies and risking a localized collapse, you buy a total world index fund. You own fractional portions of thousands of companies across the globe. When one sector falters, another sector catches the slack. If artificial intelligence creates a massive productivity boom, your portfolio captures the upside. If global energy prices surge, your portfolio captures that growth too. You sleep soundly, knowing your wealth is tied to the collective progress of human innovation, not the flawed decisions of a single chief executive officer. You achieve the ultimate diversification. By owning the entire haystack, you no longer need to search for the elusive needle. The mathematical system works for you, automatically pruning the corporate losers and riding the global winners to new heights. There is an invisible drain on your wealth that stock picking amplifies. That drain is financial friction. Every single time you buy or sell an individual stock, you trigger a taxable event. You incur hidden transaction costs. You create a complex nightmare for your accountant. For the modern investor optimizing global tax strategies, this friction destroys compound growth over time. When you utilize tools like the foreign earned income exclusion, you want your investments to be seamless. The foreign earned income exclusion is a tax provision that allows United States citizens living abroad to exclude a large portion of their earned income from federal taxes. However, this exclusion does not apply to passive capital gains generated from day trading. Consider earning substantial income while living in a tropical villa in Bali. You use international tax laws to shield your initial capital. If you day trade individual stocks, you generate short-term capital gains, subjecting you to the highest possible tax brackets. But holding a broad index fund means you defer those taxes for decades. Your capital compounds in a tax-efficient bubble. You only pay taxes when you decide to sell years down the line, often at a much lower long-term capital gains rate. Furthermore, the time you save by not analyzing stock charts becomes a freedom dividend. You can use those reclaimed hours to build a scalable business, improve your physical health, or explore a new continent. Wealth is not just a digital number in a bank account. True wealth is the absolute total control over your time and attention. Indexing gives you your time back. It aligns perfectly with a nomadic, borderless lifestyle where you dictate your own schedule. Broad market indices represent the core foundation of your wealth, but true optimization allows for alternative passive strategies. If you crave regular income or alternative asset exposure, you still do not need to pick individual winners. You can use real estate investment trusts to capture global property market gains. You can explore yield-generating protocols in decentralized finance. The rule remains identical. Capture the broad trend, avoid the individual point of failure. A real estate investment trust is a company that owns income-producing real estate and is legally required to distribute almost all of its taxable income to shareholders as dividends. Decentralized finance liquidity pools allow you to act as an automated market maker. You provide capital to a smart contract, allowing other people to trade assets, and you earn a small fee on every transaction without betting on a single token. Imagine you want exposure to commercial real estate in Asia, but you currently live in South America. Buying a single office building in Tokyo requires immense capital, expensive legal teams, and deep local knowledge. Buying a specialized real estate investment trust gives you instant liquid ownership of premium Tokyo real estate. You collect the passive dividends while sitting on a beach in Brazil. The exact same principle applies to decentralized finance. Instead of guessing which new digital currency will skyrocket, you provide liquidity to a decentralized exchange. You earn a fraction of every trade made on that global platform. You abstract away the complexity. You capture the massive technological trend without taking the concentrated risk of holding one volatile asset. You become the infrastructure, and the infrastructure always wins. True financial mastery comes from building a robust machine and letting it run, rather than pulling levers all day hoping for a jackpot. You secure your capital in broad indices, eliminate tax friction, and focus your energy on generating active income and designing your ideal lifestyle. The data is clear. The passive strategy is proven, and the next step is applying these exact principles to the current global economic landscape. Discover the exact frameworks the elite use to protect their wealth right now by clicking the video on your screen titled "How the Top 1% Are Investing During the 2026 Market Shift."